12 hours from now, the Shanghai Futures Exchange opens for Sunday night trading. 14 hours from now, the Shanghai Gold Exchange T plus D contract begins pricing physical silver. 18 hours from now, the Comex Globex electronic platform resumes trading at 6 p.m. Eastern. And somewhere between those three opening bells, the silver price is going to move, potentially violently, potentially by $5 to $10 in either direction. And there's nothing you can do about it once it starts, because the gap happens in the transition window between closed Western markets and open Eastern markets, where liquidity is thin and price discovery is controlled by whoever is willing to trade. I'm not sleeping tonight, and after you see the data I'm about to walk through, you will understand why. Silver closed Friday at $69.57, up 2.22% from Thursday's carnage, bouncing off the 66.78 low that was engineered by the 3:47 a.m. stop-loss hunt. The market looks like it is stabilizing. The weekend feels calm. And that calm is the most dangerous thing in the silver market right now, because the calm is hiding 7 data points that are all converging on Monday's open simultaneously. Data point 1, Iran rejected the U.S. ceasefire proposal. Not delayed, not modified, rejected. Tehran called the proposal one-sided and unfair and stated publicly that they are not open to direct talks with Washington. There is no meaningful diplomatic progress between the two sides, according to analysts tracking the negotiations. Trump's April 6th deadline is 8 days away. His cabinet meeting statements included threats of more targets to hit, and he has not ruled out ground troops. The Pentagon is reportedly considering deploying up to 10,000 additional troops to the Middle East. The market priced a temporary de-escalation last week. That de-escalation has now been explicitly denied by one of the two parties involved. Oil tells the story. Brent crude is at $114.50. Up 5.7% for the week. The Brent WTI spread has blown out to over $10, a level that historically sits at $2 to $3. A spread that wide signals a structural supply disruption in global oil markets, not a temporary price spike. The WTI is trading near 2022 highs. The Iran conflict is not a headline risk. It is an active economic shock that is restructuring global energy pricing in real time. When the Shanghai market opens tonight and processes the weekend's information, the Iran rejection is the first variable Chinese traders will price. Oil at 114 means inflation across Asia accelerates. Asian currencies weaken against the dollar, and the historical response in every Asian economy when currencies weaken and inflation spikes is immediate conversion of paper money into physical precious metals. Not Bitcoin, not stocks, physical gold and silver. That is the cultural and historical pattern across India, China, Japan, Korea, and Southeast Asia for thousands of years. Data point 2, the dollar broke 100. DXY closed at 100.15, above the century mark for the second time in 3 weeks, on track for its best month since July 2025, up 2.6% in March. JP Morgan turned bullish on the dollar for the first time in a year. Every mainstream analyst is telling you the strong dollar is bearish for silver. They are right in the short term. The inverse correlation between the dollar and silver is one of the most reliable relationships in commodity markets. But here is what they are not telling you. The dollar is rallying on fear. Safe haven flows driven by the Iran war are pushing capital into dollars. This is a reflex, not a fundamental repricing. The underlying fiscal condition of the United States has not improved. $10 trillion in debt needs refinancing over the next 12 months. Annual interest payments exceed $1 trillion. The Treasury auctioned $69 billion in 2-year notes last week with the worst demand since March 2023. When fear-driven rallies exhaust themselves, the reversal is proportional to the overshoot. A dollar that has been pushed to 100 on war fear while the fiscal foundation is crumbling will fall harder and faster than a dollar that reached 100 on genuine economic strength. And when the dollar reverses, silver moves inversely. The stronger the dollar overshoot, the more violent the silver recovery. Data point 3. Comex inventory dropped 2.5 million ounces in a single day. The March 26th warehouse report showed total inventory declining by 2,505,867 ounces. That is not a gradual leak. That is institutional scale metal being pulled from the exchange system at an accelerating pace. Registered silver has declined 11.9% in just 30 days, 10.3 million ounces withdrawn in a month. Coverage ratio at 13.4%. Deep in stress territory where anything below 15% is historically associated with delivery squeezes. The Comex is in backwardation. Spot silver costs more than futures. This is the market telling you in its own language that physical metal is needed now, and participants do not trust that it will be available later. Backwardation is the rarest structural signal in commodity markets, and it is present right now going into Monday's first notice day. Data point 4. April. First notice day is 2 business days away. 1,726 contracts remain open, representing 8.6 million ounces. This comes after December delivered 65 million ounces, a single month all-time record. January delivered 49.4 million ounces, more than 7 times January 2024's total. February delivered 25.18 million ounces, the highest February in modern Comex history. March saw 10,526 contracts standing against 86 million registered. All of 2025 saw 474 million ounces delivered compared to 203 million in 2024. Deliveries more than doubled in a single year. The behavioral shift toward physical delivery is not a temporary phenomenon. It is a structural change in how institutional participants are using the COMEX. They are no longer treating it as a trading platform. They are using it as a delivery mechanism to extract physical metal from the vault system. And Monday starts the next extraction cycle, with a vault that has been gutted by 4 consecutive months of record withdrawals. Data point 5. The Shanghai Gold Exchange silver inventory hit 10.24 million ounces on February 9th, the lowest since 2015. Shanghai inventory dropped from 559 tons in November 2025 to 318.5 tons by February 2026, a 43% decline in 3 months. The Shanghai Metals Market Daily Review confirms that suppliers are reluctant to sell and have chosen to wait on the sidelines. The SHFE silver futures contract was last quoted at 1944 yuan per kilogram, approximately $89 per ounce equivalent. COMEX is at 69.57. That is a $21 gap between the Eastern physical price and the Western paper price. When the Shanghai market opens tonight, that $21 gap is live. Chinese traders see COMEX silver at 69. They see SHFE silver at 89 equivalent. The arbitrage signal is deafening, but the arbitrage cannot be closed through physical flows because China's export licensing regime prevents silver from leaving the country. The gap is structural. It persists, and it widens every time the COMEX paper price drops, while Eastern physical demand holds firm. The only way the gap can close is for the COMEX price to rise toward the Shanghai price, not the other way around. Data point 6. The COT report as of March 24th shows speculative positioning at levels that historically mark cycle bottoms with extreme precision. Speculative gross longs and gross shorts have both collapsed to 13-year lows. The paper futures market is being abandoned by speculators while physical delivery demand has never been higher. Managed money holds just 8,500 contracts long. Large speculators' net long exposure is near a 2-year low at 22,000 contracts. The paper game is being vacated by the traders who play it. The physical game is being intensified by the institutions that understand what is actually happening. Commercial shorts, the banks, hold 69,799 contracts short. That is 349 million ounces of paper silver being held short by the banking sector, against registered inventory of approximately 76 to 124 million ounces, depending on which classification you use. The banks are short 3 to 4.5 times the deliverable inventory. StoneX analysis states that net long positioning may have formed a trough 4 weeks ago. Large speculators increased both longs and shorts slightly, the first sign of renewed interest from traders who had completely abandoned the market. This is the exact positioning fingerprint that preceded the January rally from 33 to 121. The specs washed out. The positioning troughed, then price quadrupled. Data point 7. The Sprott Physical Silver Trust doubled its capital raise to $2 billion in January 2026. That is enough to purchase approximately 18 million ounces, representing 16% of COMEX registered inventory in a single institutional move. One fund, 16% of the vault. When institutional buyers of that scale are entering the physical market with that kind of capital commitment, it tells you something about where the informed money believes prices are headed. Now let me map these 7 data points onto what happens in the next 12 to 18 hours because the sequencing matters. Shanghai opens first, approximately 12 hours from now. Chinese traders process the Iran rejection, the oil spike, the dollar at 100, and the $21 gap between SHFE and COMEX pricing. If they bid silver higher, and Friday night's 2.56% SHFE rally suggests they will, the Shanghai price moves first while COMEX is still dark. The gap between East and West widens further before any Western trader can react. India processes next. Indian silver is at approximately 2,45,000 rupees per kilogram. The rupee has been under pressure. India imported $9.2 billion in silver last year, up 44%. Indian physical demand during periods of currency weakness is historically aggressive. If Indian buyers step in tonight, they pull physical supply from the same global pool that is already running a 67 million ounce annual deficit. Then Comex Globex opens at 6 p.m. Eastern. The first Western electronic contracts trade against whatever price level Shanghai and India have established over the prior 12 hours. If the Eastern markets have pushed silver equivalent to $73 or $75, the Comex open gaps to that level instantly as arbitrage algorithms buy the cheaper Western contract. If Eastern markets traded flat, the Comex opens near Friday's close, and the real action waits for Tuesday's first notice day settlement. The asymmetry of this setup is the reason I am not sleeping. The downside scenario, where everything calms over the weekend and markets open flat, produces a Monday open of approximately $69 to $70, essentially unchanged. The upside scenario, where the Iran rejection triggers risk repricing, Shanghai bids higher on the $21 gap, and short covering begins ahead of first notice day, produces a Monday open of $75 to $78. The catastrophic downside scenario, where the CME announces a margin hike Sunday night to protect the bank's 349 million ounce short position before first notice day, produces a flash crash to 64 to 66 that reverses within days as physical premiums explode even higher. In every scenario, physical silver in your possession is unaffected. No gap risk, no margin call, no stop loss hunt, no CME rule change, no authorized participant redemption. The eagle in your safe does not know what the Comex Globex price is at 6 p.m. on a Sunday. It is still 1 ounce of 999 fine silver, regardless of what any exchange, algorithm, or bank does tonight. The structural context underneath Monday's open has not changed despite the 43% crash. Sixth consecutive supply deficit at 67 million ounces. Cumulative shortfall exceeding 820 million ounces over 6 years. Exchange inventories accounting for only 19.6% of that gap. The remaining 80% absorbed by irreversible industrial consumption. Solar panels, electronics, EVs, metal that cannot return to market. Comex registered drained 70% since April 2020. Shanghai drained 43% in 3 months. Delivery volumes doubled year over year. Speculative participation at 13-year lows, while physical demand hits all-time highs. Silver was $33.64 this time last year. It is $69.57 today. That is a 100% year-over-year gain despite the 43% crash from the all-time high. The crash erased the speculative overshoot from January. It did not erase the structural repricing that took silver from 33 to 69 over the prior 12 months. The 6-year deficit is still consuming stockpiles. The delivery run is still accelerating. The Eastern physical market is still pricing silver $21 above the Western paper market. And the banks are still short 349 million ounces against a vault that is draining towards zero. The $54 zone that capped silver rallies for over a decade has flipped to structural support. The head and shoulders breakdown target of 65 has been hit and exceeded to the downside, with the $60 low on March 23rd aligning with the 0.618 Fibonacci extension. These are textbook exhaustion levels where technical selling meets structural buying and the direction reverses. Bank of America's scenario range is 135 to 309. Citigroup projected 100 by this month. JP Morgan's Q1 target was 84. Silver is at 69 with 2 days left in Q1. The gap between institutional forecasts and market reality is the widest it has been at any point in 2026. Either every major bank's metals research division is wrong simultaneously, or $69 silver is a pricing anomaly that is about to correct violently to the upside. 12 hours. Shanghai opens first. India follows. Comex follows India. The Iran rejection is unpriced. The $21 east-west gap is unresolved. The first notice day delivery pressure is 2 days away. The KOT positioning is at a trough. The speculative market has been abandoned. The physical market is on fire. I will be live the moment Shanghai opens. Tracking the SHFE silver contract tick by tick. If the gap starts forming, I'm publishing an emergency alert before the Comex opens so you have time to position. If Shanghai trades flat, I will post a brief update confirming no gap, and we wait for Tuesday's first notice day. Subscribe. Bell on. Tonight matters. Stay sharp.